money, 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 money. Crazy about my money. Money, 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 money. Crazy about my money.
So we meet with a lot of couples on a regular basis and we talk about financial planning, and sometimes we just talk about the secret to happiness. And what we say is it usually boils down to three magic words.
Yeah, three magic words. We all know those words. Individual retirement account.
Classic, also
Yeah.
known as an IRA. And that can really form the foundation for a lot of financial planning.
Yeah, no doubt. So when we talk about IRAs, we do get a lot of questions and they can be a little confusing. There's two primary types of retirement accounts that we discuss a good bit with clients.
Right. And it really boils down to when you want your tax break, now versus later. There's traditional IRAs and then there's Roth IRAs.
All right, so we'll start with the traditional IRAs. Traditional IRAs, think about as pre-tax accounts. What you're doing there is you're taking dollars from your income and you're contributing it to an account that can hopefully grow and in time defer when you pay those taxes. So talk about what that means for tax deferral.
Right. So we're not talking about tax avoidance. What we're really talking about is the money that you put inside that account. You can buy and sell things all day long, and you don't have to worry about any of the tax ramifications until you begin withdrawing that money. And any money that comes out of that IRA account, typically at retirement, is going to be taxed at that point as ordinary income.
The theory being that you're at a lower tax bracket in retirement, correct?
Right.
So with traditional IRAs, in most cases, you can actually deduct that from your income. Obviously, working with a tax professional to do so, and when you're filing taxes. But that's an immediate advantage.
It is.
What age can you actually start to pull that out without a penalty?
So the government decided that age 59 and a half is the magic number at which you can begin to withdraw that money without any additional penalties associated with that. Now, there's a few loopholes there. If it's a qualified first-time home purchase or certain education expenses or healthcare expenses, there you can withdraw pre-59 and a half and avoid that 10% penalty. But talk with your tax professional because there's some pretty specific exclusions.
Got it. And listen, that's a huge thing, though. I mean, being able to defer taxes is a great vehicle. There's another type of IRA that does it a little bit differently. It's called a Roth IRA.
That's right. Yeah. Roth IRAs kind of work the opposite. You don't get any tax break on the front end. You put in $5,000, it doesn't help you at all. You don't get to deduct it. But in theory, over time, that money compounds and grows and ultimately can come out of the account tax-free at retirement.
Got it. So say you're in your mid-20s, you're just starting out your career, you're setting aside a few $1,000s into a Roth IRA. You've already paid taxes on those dollars. Hopefully those dollars are compounded many times over.
Right.
And whenever you actually hit retirement, you've got a large bucket to work with. All of that money that has then grown in time is then able to be withdrawn tax-free.
That's right. And age 59 and a half is still the magic age, even for Roth IRAs. Now, pre-59 and a half, you can make withdrawals based on the contributions that you've put into that account, but you can't withdraw earnings without incurring a 10% penalty.
That's important to remember because, in many cases, somebody says, hey, where can I pull emergency funds from?
Sure.
A Roth IRA can potentially be a place to do that because you can actually pull those contributions out without creating a taxable event there.
That's exactly right. Yeah.
Okay. All right. So we talked about the age associated with those things. RMDs is something we hear a little bit about, and I think that's an age-related event as well.
Yeah, RMD stands for Required Minimum Distribution, and there's a certain age at which the government forces you to begin taking withdrawals from that account, and that age currently is 73 years old. The logic behind that being the government doesn't want those accounts to live tax deferred in perpetuity. At some point, they want to begin to tax the money that you've set aside. And so arbitrarily, the decision was made that 73 feels like a good age. And so at age 73, there's a certain table that you have to follow to take withdrawals.
All right. So that is only related to one of those types of IRAs, the traditional IRA, correct? So don't have to worry about an RMD with a Roth IRA, but with a traditional IRA, it is something you want to keep in mind. All right. And then another question we get a good bit of is, what type of contribution can I make on an annual basis to an IRA?
Yeah, so there are caps. There are limits to how much you can put into an IRA. Right now, if you're under age 50, you can contribute $7,000 a year. If you're over age 50, they give you a catch-up provision. You can contribute up to $8,000 a year.
Okay.
And you can split it. You can do $3,500 and $3,500, but the total IRA cap is capped at $7,000 or $8,000 respectively.
it's always important to have multiple buckets, especially as it relates to your tax situation. And we always encourage that. We encourage kind of diversifying your overall financial picture.
Yeah.
The important thing to remember is to assess each situation differently, right? You want to consider, hey, what makes sense for me? What are my goals in retirement? What are my goals currently? What are the tax situations I've got? And then working with an advisor or a tax professional as well to really make sure that you're selecting where to make those contributions is an important thing to building long-term wealth.
Money, money, money. Money, money, money. Crazy about my money.